Hello, everyone. Welcome to our premiere show. My name is Matt. I am a senior software engineer, and I am a graduate of Southern New Hampshire University. Someone else go.
Okay. Hi, I'm Frank. I am also a software engineer. I have graduated from USF, and yeah, it's Rush.
Hi, this is Suraj. I am a software engineer at Health First, and I graduated from OU, Oklahoma University.
Hi, my name is Eric. I am a senior software engineer, currently working for Harris, and I graduated from Kutztown University in Pennsylvania, and I'm happy to be here with my friends.
That's right. And what we're doing is the four of us have decided to create a web application to help us in our market research and investing, because that's what we do as a hobby. We like to do stock investments, possibly futures in the near future. And we wrote software to help us do this. The software is freely available for everyone to use at www.javion.com, JEAVION.com. The software is in its infancy stage right now. There's some predictive formulas being used. There's also forums that just went up and are active, and it's freely available for everyone to use. And we decided to start this YouTube channel so that we can have discussions on investing and market research to reach out to people who are also interested in investing in market research. And our topic today is the calm after the storm. Now, what that means is, you hear a lot of people say buy low and sell high, and what that means is, stock price will go down, and you buy it when you think it hits the floor, and the time to buy is when it's the calm storm, like it hit the floor, and the stock price starts to raise again. And the most recent and popular example is the recent thing with Apple. Now, Apple was recently hovering around about $110 a share, and they had their first quarter earnings for this year in 2016. And they still made money, but they didn't make as much as they thought they were going to make. So their stock price dropped down to about $90 a share. And when it hit that price, Warren Buffett, for those of you who don't know who Warren Buffett is a major stock investor. I mean, you may or may not agree with his politics, but the guy is a genius when it comes to investing. So he made his billions, in the stock market. So Warren Buffett put $1 billion into Apple when it hit about $90 a share, and now it's about up to $100 a share again. So he made quite a ton of money in a short amount of time. Now, the reason why he was able to do that is because he knew where the calm after the storm was. So how do we figure out where the calm after the storm is? I mean, did he use a formula?
Guys, I want to.
Sorry? Okay, I didn't hear what he said, but he looks like he stepped away for a moment. So how did he know where the calm after the storm was? I mean, did he use a mathematical formula? I mean, did he just guess? I mean, I think we all knew that Apple wasn't going to go out of business, but how did he know that $90 a share was going to be the floor? What are your thoughts on that? Frank? Did we lose you, Frank?
No, all right, something happened.
Are you guys still there?
Can you come back to me in a second? I'm having technical.
Yeah, I'm here.
Okay, so Eric, what are your thoughts on that?
Okay, that's a very good question. And one reason why Warren Buffett made his billions of dollars is because the man, I like to see him as being somebody that's like I want to say like a futurist. And the reason why I say that is he's able to kind of see potential more than current value. So he knew pretty much that Apple was being sold at a discount, and he knows with the talent currently in Apple and the investments they make with their developers, with their engineers, and in their products, that Apple will do better. they
Hmm.
will do better. So Warren Buffett doesn't need the money. So it's safe to say that when he invested those millions of dollars, one, it helped the stock, and two, he didn't need the money right away. So it's like he made this investment as more as like a long-term investment because he knew that Apple will recover because of that because he sees more the potential of a company than its current value. You see if that makes any sense or not? I
Yeah,
don't know. Do
but
you?
but one thing I'd like to figure out is though how exactly did he know that that was the new floor, the $90 a share? I mean, was it the fact that he himself invested $1 billion in Apple? Was that the triggering event that caused it to go back up to about
No.
$100 a share?
You have to keep in mind that this man, and I know you guys see more light, and you guys can see me a little bit more, Saraz. You can see me a little bit more.
Nice hat.
Oh, now it's gone. Okay. But yeah, so pretty much, right? Warren Buffett, he is a billion-dollar investor, right? So
Mhm.
he has analysts working for him. So these analysts looked at pretty much why Apple fell. They felt like the damage was pretty much coming to an end of why Apple fell. And they pretty much told him, like, look, we think now is a good time for you to invest your millions of dollars into shares. So I think Warren Buffett himself didn't know, but the people working for him, looking at the charts, doing their research, looking at cash flow in a company, looking at
Mhm.
potential other investments Apple's investing in, and potential other services, and like Apple's also a service provider as well as a hardware provider and software provider. So they looked
Mhm.
at all these things and they determined, like, look, Warren, you need to get in now, or the stock is going to start creeping up. When he infused his millions of dollars into the shares, he helped it rebound because when people see somebody like Warren Buffett make a move like this, all of a sudden they're starting to question their negative sentiments about Apple. So he helped drive the market.
Yeah,
I'll argue that if he didn't invest into Apple, it would have fell further, but not by much.
that's interesting. Now, Apple, I'm looking at our own software that we wrote, www.jvn.com, JEAVION.com. And now the PE ratio on Apple is 11.18, and the PEG ratio is 1.3. And that's actually, still pretty strong for the company. So they're definitely not losing money.
Yeah.
And
And Matt, I have to say, you really wrote that software for the record.
well, that's okay. I mean,
Yeah, I mean, you did it. Yeah,
I mean, we're all four of us. We're all professional software developers. We all
yeah.
have full-time jobs and families, so we all do what we can in
That's
our
great.
spare time to further this software project along. And it will go on much further. I'm sure all of us will have equal work put into it at some point. And but more features will be added. I mean, we would love people to join us in our discussions on our forums to help us to help you how to invest. The people who are paying attention to us anyway. So here, the short-term moving projection, and this is a formula that we use using weighted moving averages. The software thinks that Apple will rise up to about 101.71, $101.71 tomorrow as its closing cost, give or take probably around maybe 2% to 5%, 2 to 5%. The software has been pretty accurate in short-term trends, and I'm actually pretty impressed with that.
Yeah,
So
it is.
yeah, so now Eric, you have a lot of stock in Apple. Were you able to get in on it when it was down at the floor at about $90 a share?
That's a very good question. I had an opportunity to do so because, as you said, I have a lot of shares already dedicated to Apple, but I already have some stocks on margin. So the question was, do I want to go to Scott Trade and invest another 1,000 to purchase more shares, or just go ahead and just leave it as is? So I decided to leave it as is because pretty much I'm tapped out.
Oh, okay.
And but like I put it this way, every time Apple goes up by $1, I'm making about $90 to $100.
Yeah, that's awesome. That's
Yeah,
really
so
good.
that goes to show you how much stock I do have. So you know, professionally, as I try to get better at trading stocks, I look back at that and see it as, not maybe a thing I would want to do again, investing 100% of my money into one company like that. But in the meantime, while I'm investing into Apple, I think I'm going to ride this wild ride until I can at least make some profit worth my while. Because let's keep in mind, so far I've been waiting for about 10 months to a year to make profit on Apple. So even if it gets to whatever my price is, in which I kind of break out even, I still want to be able to say I made some income for the amount of time I waited.
Definitely.
Mhm.
But at least you get some dividends from that. So holding the stock for so long, it should at least pay out a little bit in dividends, which you
Yeah.
could then reinvest, which would be pretty nice. One thing I'd like to do is I'd like to see if we can come up with some kind of a mathematical formula to figure out where the calm after the storm is.
Mm.
Now, I've seen other websites, web applications attempt this, and I do have to give a shout out to optionsalpha.com. They were a pretty big inspiration for me, and kind of inspired me to write this application to try to come up with methods of prediction. But how exactly should we go about figuring out the calm after the storm? I mean, what methodology do you think would be ideal for this?
I would actually say that the lowest point would rather be arbitrary. It would need some kind of news event to kick it back up.
Do you think?
Otherwise, it's just going to be a slow, gradual drop, a slow, gradual climb. But, Warren Buffett's investment, I really think that's what sparked it.
In this case.
Yeah.
In this case, yeah.
I like the I have a different opinion about that. Like what my opinion is, it's like anything of value, like a house, for example. I have a house, and I'm sure if I were to put on the market for $1 million, nobody's gonna buy the house because it's not worth $1 million. So what's gonna happen is, if I want to sell this property and not hang on to it forever, naturally I'm gonna have to keep dropping the price until it becomes competitive based on market value. So a stock is the same way. So eventually, as the stock starts to decline, it's going to get to a point where it can't drop anymore, because out of the millions and millions of traders out there, each trader has kind of like their own idea of what a good buy is. And as the stock starts to drop more and more in that domain of what a buy is, naturally it's going to actually slow down and actually stop dropping. So one thing that I think would matter in that endeavor is somehow being able to figure out when the buys, or the number of buys on the stock is higher than the number of sells on the stock. And I think when they start to kind of reaching that equilibrium, you're kind of reaching the floor of that stock.
That is excellent, actually. So, another thing that might be indicative of a stock about to rise is to look at the standard deviation of the stock at specific time intervals. During the decline, if the standard deviation gets to a certain threshold, maybe that's an indicator that it's about to go back up in a steady way.
I mean, really, to test that, one thing I would suggest trying to do is see if you can find some stocks that had that like I see what you're saying, Matt, and that's possible, but we'll just have to test it.
Sure.
But so what you're saying is when the standard deviation starts doing what again, based on time intervals?
Well, I'm not exactly sure. I'm just kind of throwing stuff at the wall just to see what sticks, and and it's a lot of non-programmers don't know, but sometimes we just make wild guesses when we're doing programming.
That's right.
And sometimes it sticks, and sometimes it doesn't. And I did a lot of math in college, and I really enjoyed statistics and probability. And one concept that I really liked was standard deviation. And the standard deviation concept is, you have an average on a graph, but points are always above or below this average, and the standard deviation is a measure of the the numbers that go above and below this median.
Yeah.
So I'm thinking maybe as the standard deviation maybe decreases, maybe that's a good indicator. I could be completely wrong. It's it's just something that we'd have to test. Now, Siraj, you're a relatively recent college graduate. What are your thoughts on the matter?
Um, since being a college student and recent graduate, I think the formula that we created and the result that we are getting from our formula is phenomenal, and I think people should just try it and see it. We have been getting a very close result, and I think people will be very much benefited from what we are getting.
You're right; they absolutely would. But we're trying to come up with a mathematical formula for a different calculation right now. Don't.
Mhm.
It's okay. I know you're trying to pay attention to a basketball game at the same time here. So what we're trying to figure out is we're trying to mathematically calculate, or at least come up
Mhm.
with kind of a rough formula as to where the calm after the storm is. And what I mean by storm is when the value of a stock is decreasing, and eventually it will go back up. When it starts to go back up is what I'm calling the calm after the storm. And I'm
Mhm.
trying to, in my mind, to think of a way to mathematically calculate that. And Eric had a very good idea about calculating the numbers of buys versus sells. Like when buys start to increase and sell limits are starting to decrease is a good indicator. And I'm also trying to throw standard deviation in there somewhere because I love statistics. What do you think?
I also think the concept of demand and supply uh, should be used into our formula because that also affects the trading and the stock value. What do
Sure
you
does.
think?
What do you think, Frank?
Um, I've always loved the idea that it's kind of pushed by news stories, but that's always short term. We're kind of talking about long term here.
Hmm.
Well, I actually do like how you were thinking about the standard deviation of this, but over time, I would guess that you know, if we know the stock is not going to go bankrupt, eventually it's going to bounce back up to normal. So maybe there is a certain point or percentage on the standard deviation where people will realize, okay, this thing is going to bounce back. Maybe that is just hitting so many standard deviations away.
Correct.
So many percent way on the bell graph.
Yeah. Yeah, and with writing predictive modeling software, it's really hard to factor in news sources and to really make it that intelligent. I mean, we're really getting into the territory that IBM is doing with Watson. How Watson is really advanced in trying to figure things out through natural language. So maybe we can eventually incorporate the Watson Alchemy API into figuring things like this out. But until then, I think all we really have to work with are numbers, and the numbers of buys and the numbers of sells I think are really important. We're not really utilizing that right now, and that's definitely something that we should look into.
That's a good point, but then we get back to we kind of need to just throw as much as we can at the wall, see what sticks,
Exactly.
and what is working over multiple stocks over a long period of time.
And you know
Yeah.
what? And there's something else I want to add to, which is kind of like weird. But I think you guys will follow me. I see it sometimes look at stock and seeing the pricing going up and down, almost like a war. It's like a war versus buyers and a war versus sellers.
Mm.
And sometimes you might have like a hero, like Warren Buffett. Pretend like we're in a melee back in the medieval times, and this hero, you guys are meleeing, and this hero, and the morale's down, and then this hero just running into the battle and he's being successful. And it's like, let's say the king gets off his horse and he gets into the battle and he's fighting, and everybody's like, yeah, protect the king, protect the king. all of a sudden the morale just jumps up. You follow me? So
I
in,
yeah, absolutely.
in this case, you know, with Warren Buffett jumping in to the melee and buying stock, that was a real big morale booster for the
Yeah,
buyers.
yeah, it really was.
You
Yeah,
know, and then the sellers and the shorters, that really was very demoralizing to them. So it's like sometimes, well, my point is, so sometimes it's possible you can have a figure in the market that's so known that when he makes a move, it could just change. It could just change the momentum just like that.
absolutely,
Yeah.
absolutely. Yeah, and it doesn't always work with every single stock out there. I mean,
No.
Apple is definitely a good example because you know they're not going anywhere anytime soon. They're definitely
Exactly.
not going bankrupt. But with a company that's less well known, less established, your risk kind of there's a much greater risk. And I'll give an example from my own personal experience. I have 3 kids, and and they're young, so we buy them kids toys. And for 2 years in a row, we bought them products by Leapfrog for Christmas. We bought them the Leapster 2, or the Leapster 3, or whatever it was. I don't know. But my point was, we were buying them the hottest selling toys on the market. And I thought to myself, Leapfrog, they're going to be huge. I mean, if they keep coming up with these winners, they're going to be, one of the powerful toy companies of the world. And I looked at the stock, and the stock was, I think it was about $6 a share. And I bought several hundred shares of Leapfrog, thinking that Leapfrog's doing great. They're coming out with hot toys, and $6 a share, that's nothing. They're definitely going to go up. People are going to make a lot of money with this. And I was dead wrong because Leapfrog got caught up in a bunch of scandals. I'm not exactly sure what those scandals were. I think they had to do with their board of directors misrepresenting their profits or to adjust the stock prices. Like I said, I'm not exactly sure what they did, but it caused Leapfrog to drop and drop and drop and drop, and it dropped down to like $2 a share. And I thought that was the new floor, and they're definitely going to go back up to at least $6 a share. So I bought more stock at $2 a share. Well, Leapfrog went out of business, and they were purchased by VTech recently, and VTech only gave all the shareholders $1 per share. I lost a lot of money on that because I thought that Leapfrog just went on sale, and at around $2 a share, I thought that was the calm down. I was clearly wrong, and that's where risk comes in. So just to give you an example of how it can go horribly wrong for investors, and that is
But
definitely one way.
yeah, but you know, if you want to ask everybody for their opinions on that.
Sure.
Okay, Frank.
It's a tricky one.
It is.
It's definitely tricky. I was actually going to say because I think a lot of the people we might be trying to reach out to that are, learning to start getting into investing to increase, their income, they're not going to have a couple $100 out there to go buy, a lot of Apple stock. They're going to have
It's true.
these lower stocks, which do come with more risk. So,
Yeah.
I don't know. It's just kind of a tricky situation on this.
Yeah.
It
What
is.
about you, Eric?
It is. Yeah. I mean, but that was years ago when I bought all that Leapfrog stock.
Mhm.
And what I should have done is I should have looked at the interest in selling versus buying, and I should have looked at that and said, nobody's really interested in buying this stock at $2 a share, and there's really no long interest. So I just threw out a term that people might not know. When there are terms in stock investing, long and short, and a long is when you buy the stock with the intention to sell it in the future. And shorting a stock is selling stock that you don't actually own. What you do is your broker loans it to you. You sell the stock at the price because you're expecting it to go down. And then when it goes down, you do what's called a buy to cover. so that you can give those shares back to your broker that you borrowed from, and I think there's usually some interest involved in that one too. So a long is when you buy stock with the intention, with the belief that it's going to rise in value, and short, you sell it with the belief it's going to drop. So there's that, and yeah, so you got to be really careful in in your long calls there with
Now,
low price stocks.
yeah. Now, Matt, like in the leapfrog stock, like the question I have for you is that when it dropped to $2 and when you start buying up more shares, like did you do your research into the stock? Like research as in first verifying exactly why the stock fell, um, seeing exactly why they're being investigated,
Hmm.
taking a look into seeing like what other um, like if there's any kind of red flags in their balance sheets, and what and stuff like that.
I definitely didn't do as much research as I should have.
Yeah, because
And a lot of that is on me. And
but like you could certainly did a lot of more research before buying more, and still not find something. But that's something that I've been guilty of too. Um, looking at something, thinking that it's a good time to buy, but not really realizing why exactly are all the other investors pulling out. Like, what do they know that I don't know? Because
exactly,
knowledge is in this field is power.
yep, which is what.
Otherwise, you're gambling. Otherwise, you're gambling. You're playing this, the slot machines.
Yeah, exactly. And here I thought the stock was just on sale, and it turned out it was tanking.
But
And
what did they know that you didn't know?
I don't know.
Exactly.
Yeah, I didn't do my due diligence, and it really came back to bite me in the ass with that one. And it's why we decided to write this software. I mean, we decided to write this tool for ourselves to help us in our investing, and again, shameless promotion, self promotion, to make it freely available for everybody to use.
Mm-hmm.
So yeah, I definitely didn't do my research on that, and I paid the price. I paid a hefty price for it. Uh, and
Luckily, that's what we're trying to prevent.
Exactly. Yeah. Now, recently, it did happen again, but I didn't make the same mistake. I bought 100 shares of this company called Sun Edison Technology. And Sun Edison, I think they're a solar company. And I bought them with the intention of writing call contracts against this company. I don't know if we should get into call contracts today. I think that's another topic for maybe our next show.
Yeah,
But
so.
I bought 100 shares. It was just penny stock, so I didn't really care that they filed bankruptcy. So I bought like $30 worth of Sun Edison, and I wrote some call contracts against it, and I made a little bit of money because the people didn't exercise the contracts, and then they filed bankruptcy. The stock is still there, and the company hasn't disappeared completely yet, but they went lower in value. I think it's like 18 cents a share, and something ridiculously low. But yeah, you
That
just
was
gotta be
actually,
really careful. What's that?
I was going to say, that was actually an interesting one. I saw this article, and it was like within a couple days, it jumped up by like 30%.
Yeah.
And then a couple weeks after that, it just died.
Yes, it did. Yeah. I don't remember exactly what it was that sparked the increase. I know there was some talk on Reddit. You could do some decent research on Reddit for stocks, where people got in on Sun Edison when it was real low, and they got out really quick, and then it went back down. But I didn't purchase the stock with the intention of doing a quick turnaround. I was learning how to write call contracts against it. So
And sometimes we see stock like jump like that strongly, it can just tank out, and there's really no article or news to actually kind of cover that drop. Usually, what that's caused like a pump and dump.
yeah, can you talk about that a little bit?
Yeah, because like pumping and dumping, like I just pretty much explain what that is. This case, nobody knows who's going to be listening to this. Pumping and dumping is when you either have a group of investors who have a relatively a lot of money, or you have you can have an investment firm who has a lot of other people's money, And what they do is you find a stock that's relatively cheap and you buy a lot of those shares. Well, by buying a lot of those shares, when you have people kind of looking for new investment opportunities, you yourself or a group of you are able to actually make that stock artificially increase. When I say artificially, when a group of you guys come together to purchase a stock for no reason, it's not increasing based on market forces. It's being increased artificially, and
Hmm.
that's where the pump comes in. So when I'm coming out there, me, a lonely investor looking for a new opportunity to invest in, I see the stock increase 4%. Of course, I'm going to be hoping that the stock is going to go up more, so I'll invest in it then. Because I see many stocks that had multi-day increases. So that's just me, but there's 100,000 other me's out there who are doing the same thing. And as we are being introduced to this stock, and because it's a stock that's not relatively expensive, as hundred thousands of me come into the stock, we start the snowball effect. Now the group of investors who started this pump, when it gets to a certain price that they're happy with, then they all pull out. And me being a relatively okay investor, when I see that stock drop, I put my stop limit in. Once it drops like 3% of what my earnings, what the high was, then automatically it's going to sell my stock. Now you
Hmm.
have 100,000 of me doing this. That stock is going to drop like a rock.
Yeah.
You
Yeah.
know,
So would you say that an indicator for a classic pump and dump, would you say that it's just a sudden increase with no news behind it? There's no
Ex-
explanation for the sudden increase?
I would say yes.
And
I
that's
think that would be a red flag.
interesting. That's
Now,
But we're
it's
not talking about
possible.
small amounts. We're talking about, something over 10%. These people are putting in a lot of money knowing that they're going to get some return out of it. There needs to be like no key for why this has happened.
Yeah,
Uh,
and see, and doesn't they don't necessarily have to drive the stock up 10%. It's like they have to drive it up just enough to get people's attention. Driving it to 4 or 5% might be enough to get people's attention. The excitement that brings is what drives it higher.
wow. So this is like the opposite of the calm after the storm, sort of.
hmm Complete opposite is creating a false bubble.
Yeah.
Yes, exactly, exactly.
That's interesting. So the pump and dump is the opposite of the calm after the storm. That's yeah, I never put that together. That's
Mm,
interesting.
yeah,
Definitely something to watch out for.
yeah, and it's like um, and that's what makes things so tricky, because sometimes people have insider information, and because with that insider information, they purchase a stock, which causes the increase when there's no articles yet to validate that increase too.
Yeah.
So it's a little tricky there.
Yeah. So a good tool. One thing that we may want to incorporate at some point into our own software is maybe searching Twitter for stuff like that, because usually Twitter is the very first thing. It's like the microphone. Twitter is this application where everybody has a microphone and people are so hooked on social media, they pick up that microphone as soon as they learn something.
That's
And,
right.
and a big one is mergers.
Oh yes. Oh
When a
yeah.
when a company is about to purchase another company, they get on Twitter, and if you happen to be the first person to catch that tweet, you can make a lot of money.
And that's a very, very good point, Matt. I
Yeah.
mean, because to me, a classic example of that is what's his name? I'm forgetting his name. Um, but it's a guy that used to own Beats.
Beats Dr. Dre.
Dr. Dre, thank you, Dr. Dre. And so when Apple was talking about joint interest in buying Beats, Dr. Dre immediately jumped on Twitter and said, "I want to be like the first rapper billionaire." And the documents weren't even signed yet. So sometimes people get very excited about that, and they do run to Twitter to start boasting. So I think and that's just a real world example of what you said right there.
Like a double-edged sword. Yeah.
Well, they
Yeah,
still
it
purchased.
actually was. Sorry, go ahead.
No, I was just saying that they did purchase it though. Apple still purchased it, But the lawyers were like, they told him like, hey, you shouldn't really do this until the deal becomes public.
Now, would that be considered insider trading?
That's a very good question. Uh, I would say no, because it's almost like he kind of made a mistake and just disclosing information too soon. To me, insider trading is when, a friend of mine working for a company I previously worked for before calls me up and says, hey, this company is about to be sold out. If you want to, you should buy a bunch of their stock. So I think insider trading has to be a little bit more malicious than somebody hopping on Twitter and saying, hey, we're about to be bought out. Oops.
Yeah, see, I'm not really too, being a software engineer, I'm really not all that familiar with laws and how laws work and all that. So I don't really know how insider trading would work or how you'd get in trouble for it. But how exactly how exactly do people get in trouble for insider trading? I mean,
I could tell you.
Sure.
Okay. So people get in trouble for insider trading when their stockbroker rats them out. It's funny. It's like, will they do that? Yeah, they will do that. Scott Trade would do something like that. Trade King would do something like that. Now, how they rat you out? Let's say you're trading stocks, right? And on average, you make X amount of money within a period of 6 months. All of a sudden, in 1 month, you triple what you normally make, or quadruple it. That's a red flag right there.
Huh.
And it is based on how much money you make. Now, if you quadruple it and that equals like $100 or $200, they might just let you go. But if you quadruple it and that means $20,000 to $30,000, somebody might ask you, how did you know to make this investment when you just pretty much when your investments pretty much went up 1,000% all of a sudden?
Huh.
They will ask you that, because they want to know how you know that information. And so that's one way. So then what happens is they look at the company and they see the company that helped you. Now the question is, did you used to work at this company before, or do you know anybody in that company? They could literally do an investment. Now it's based on the amount of money you get. If it's just like maybe $200 or $300, they probably won't care, but they still look at it, but they won't get in touch with you. But if it's like $50,000 to $100,000, they're gonna want to know what's going on.
So is there some kind of incentive for them to rat you out?
Well, it's just that it's more about them just having a good reputation of following government practices more than anything else. Yeah, it's almost like the government's not gonna give them a kickback for ratting you out. It's more like, hey, we seen something that looks a little suspicious, potentially insider trading. Why don't you take a look? And the government's gonna want to know, why do you say this? This guy has been losing money. Most of the time he had this account, and all of a sudden he's making these huge gains.
Yeah.
It's uncharacteristic based on this type of investor, pretty much.
Interesting.
And I'm sure if you read the fine print, you'll find that. Or just Google it. And I don't know if you want to look into that right now about some of the stuff I talked about, but you might be able to find some resources on it.
Excellent. No, I actually think we're at a pretty good stopping point for today. We covered some really interesting topics, and we had I think, a very good first show. And we definitely need to continue doing this on a weekly basis, maybe even twice a week if we have time, to share our knowledge and connect with people. So I think if it's all right with you guys, we're going to tell people to subscribe and leave a comment. Visit our website.
Yeah, we would definitely love feedback for this.
Absolutely. So leave a comment below. Subscribe to us. We're going to set up our Twitter account and a Facebook account at some point. Siraj, being our resident millennial, he's the expert in social media. So we'll get him on that. All right. So remember, jvion.com, JEAVION.com, and I will see all you guys later. Great talking to you.
Yep.
You too.
See ya.
See you.
Good.
Fine. Bye bye.